Hey everyone, welcome back to Corporate Decoder. Today CORE and MAIN Incorporated just filed an 8K, and I am seeing a big shift in their debt strategy. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is taking on new debt tied to long-term growth, and it signals a potentially more aggressive expansion phase. So what is this filing all about? Core and Main is essentially updating us on some major financing moves they've made. Think of it as them telling the public and the investors, hey, we've just locked in some new loans and notes. The key thing here is that this is a current report, meaning it is about important events that have just happened or are about to happen, and they need to tell us about it right away. One of the biggest pieces of news is that Core and Main LP, a subsidiary of the main company, has issued $750 million in senior notes that are due in 2034. These are basically IOS that the company is selling to investors, promising to pay them back with interest by 2034. The interest rate is 6%, which is pretty significant. They are planning to use the money from selling these notes to pay off some existing debt, specifically a term loan that was due in 2028, and also for general corporate stuff like growing the business, buying other companies, or even buying back their own stock. It shows they are actively managing their debt and reinvesting in the company. Now, what is interesting about these notes is that Core and Main has the option to buy them back before they are due. This gives them flexibility. If interest rates drop significantly or if they have a lot of extra cash, they can choose to pay off this debt early. They can even do something called a make-whole premium if they decide to pay it back before 2029, which means they would pay a bit extra to compensate the note holders. They can also use a portion of money from selling stock to buy back up to 40% of these notes, which could be a way to reduce their debt load if they have a successful stock offering. On top of the new notes, they've also amended their existing term loan credit agreement. They basically refinanced a 2028 senior term loan, which was due to mature in July 2028, into a new $800 million senior term loan that will now mature in July 2033. This is a pretty big extension. The interest rate on this new loan is tied to something called term SOFR, which is a benchmark interest rate plus a margin that can range from 0.75% to 1.75%. There is also a floor on the interest rate, meaning it won't go below zero, which is standard. Here is a subtle but important detail. If they decide to pay off this new 2033 senior term loan early within the first 6 months, there is a 1% prepayment penalty. This is common for new loans, encouraging lenders to see the loan through for a certain period before it is repaid. It is a sign that the company is structuring this debt to be a longer term part of their financial plan. Like any debt agreement, these new notes and the amended term loan come with conditions. The filing mentions customary events of default. This means if the company fails to make payments, breaches certain promises, or faces bankruptcy, these could trigger a default. They also have negative covenants, which are basically promises the company makes not to do certain things without the lender's permission, like taking on too much more debt or selling off essential assets. It is all about managing risk for the lenders. Now, digging into the actual numbers behind these deals, the 6% interest rate on the $750 million notes means they will be paying around $45 million in interest per year just on these notes. That is a substantial amount, extending the term loan from 2028 to 2033, and taking on $800 million means they are really leaning into a long-term debt strategy. This could be to fund significant expansion or acquisitions, or perhaps they see current borrowing costs as favorable for long-term capital. Looking at Core and Main's market context, they are in industrial distribution, a sector that can be cyclical but also provides essential services. With a market cap of around $8.7 billion and a PCE ratio of about 19, they are a significant player. Recent news is all over the place, from AI in game development to computer security, which doesn't directly tie into this filing, but it shows the broad economic backdrop. The fact that they are raising this much capital and extending debt maturities suggests they are confident in their future growth prospects. They're essentially betting that the returns from their investments will outweigh the cost of borrowing. One of the key insights here is that the company is proactively managing its capital structure. They are prepaying older, potentially more expensive or shorter-term debt and replacing it with longer-term fixed-rate debt. This financial engineering can offer stability in uncertain economic times. However, it also means they are committing to significant interest payments for many years to come. My biggest concern is always how much debt a company takes on versus its ability to generate cash. Pushing out debt maturities is smart, but if the underlying business doesn't grow as planned to service that debt, it can become a real burden. The 6% rate on the notes is not insignificant, and the $800 million term loan will also carry its own interest costs. Investors will need to watch their profitability very closely to ensure they can comfortably handle these new obligations. The risk I am watching is that while this move provides financial flexibility now, it increases their long-term leverage if economic conditions worsen or their internal growth targets are missed. Servicing this debt could become a major challenge. What I am actually looking for is clear evidence in future filings that the capital raised has translated into tangible revenue and profit growth that significantly outpaces these new interest expenses. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this breakdown helpful, please give it a like and subscribe for more. Join the Discord for more discussions.